Welcome to the Dealmakers Podcast, sponsored by Dealmakers Institute. This podcast is dedicated to exploring and uncovering exciting deal-making truths with those who are making it happen every day. You'll discover ways to leverage and profit from every aspect of the deal-making pipeline, from acquisition to exit. And now, the founder of Ribbon Equity and one of the leaders at Dealmakers Institute, your host, Bentley Jean.
Hi, welcome to another episode of the Deal Makers Podcast. I'm your host, Bentley Jean, and today we have Jake joining us from Bright. Jake, how are you?
Doing well, Bentley. Thanks for having me.
Thanks for being here. And for our audience that may not be familiar with you or Bright, can you give us an overview of who you are and the company you're representing today?
Yeah, I'd be happy to. So thanks again for having me. Again, my name's Jake Hartigan with Bright Funding. It's a crowd investing platform connecting small retail investors to technology companies and real estate opportunities for investment through the new Reg CF regulation. So basically letting small investors participate in investments that they might not have legally been allowed to not too long ago, which is really exciting, really cool stuff. And I'd be happy to jump into it shortly.
Okay, perfect. Thank you for that. And again, for our audience listening that may be new to the space, can you provide an overview of how crowdfunding work and how was crowdfunding established in the first place?
Yeah, so some kind of like background to leading up to where Reg CF, which is regulation crowdfunding, has been allowed. A while back, there were laws written to protect small investors who maybe weren't sophisticated in how they approached investing, or if they did invest in private equity or investments that were too expensive, we'll put that term there, they might lose everything. So to protect them, they were restricted and not legally allowed to in many cases. And so that's where things had been for as far as the U.S. is concerned, many years, until the Jobs Act was put into place about 5 or so years ago, where the regulation changed to allow small investors to start investing in earlier stage, maybe higher risk opportunities, even if they didn't meet the original financial requirements, where you had to be making close to $250,000 a year to be able to even participate. And so this basically opened the doors up to at least the limit of $1 million investment opportunity. So a good example would be buying $1 million house. You weren't allowed to invest in that as a small investor with a group entity to build or invest in that opportunity before this Jobs Act. Now, even if you didn't make that minimum financial requirement, you could participate. And there's a whole bunch of other benefits that were kind of brought along with it.
Yeah, absolutely. I think there's a lot of activity and interest in this space, and especially within the last couple months where there's
Yep.
the cap was recently raised to 5 million. So giving all the activity, all the space, one has to ask the question, is it justifiable? Is the hype real? What would you have to say about that?
Yeah. So a little bit about my own perspective. I got into this space not long after the Bitcoin had hit its first mega peak. And it was a whole environment of technology and democratization hype. This is not the same. So that was a big difference in why I ended up wanting to enter this space, is that it is very much not a hype process. It's a very controlled, regulated process. But the opportunity and the upside of what it's allowing people to do, because there are so many more sophisticated small investors than ever before with the internet and with, education at, its largest, and people being able to know for themselves what they really want to invest in, not just, the Coca-Colas of the world and, the large corporations that they can reach through the stock investing, but even like their own real estate or small businesses that they want to help back. That's really what this is allowing, and that $5 million, raise is extremely justified because the first companies that got into this space were at a bit of a disadvantage. So Bright was founded just the beginning of 2019, and only in 2020, after going through a very rigorous process of becoming a registered crowdfunding portal, were we able to then start bringing in issuers to then start raising funds at that original $1 million mark. And this is something that, 40 or so other platforms had done before us. But because of that $1 million limit, the cost of raising funds, the time invested, and the effort to just get up to $1 million, it was definitely helpful, but not as much as this 5 million would be. And it's not going to change it's not going to rock the boat, if you will. And so you can read about this by the SEC's ruling and kind of the reasoning behind it through their website. But to kind of give a synopsis of it, they determined that if they lifted the limit to 5 million, it's not going to take away from the NASDAQ and, the stock exchange. Those are still going to be there. They're going to be fine. 5 million is not going to affect any other private markets, VCs and, series A and B and beyond that. These are really just to help those starting companies that maybe have a high technical, threshold to get started, like a manufacturing process, a new technology that they need to develop further. Maybe it's just getting rolled out to a broader audience, and they need to reach that 5 million or somewhere in between the 1 and 5 million that they couldn't originally do. So this is going to lower the cost of raising funds because you're limited for, each year, whatever that minimum amount is. Previously 1 million, you could only raise 1 million in that year, and then would have to run another campaign the next year up to that maximum limit again. And they were seeing this happen again and again, and that would basically be charging the companies twice to do the same raise that they could have been doing now in one go. So it's less expensive for the platforms to host these. It's also less expensive for those companies to then raise those funds, especially if they know they're going to go there anyway.
Absolutely. And you mentioned that Bright was started in the early 2019. Again, can you provide an overview of Bright, their services, and how Bright is different from, let's say, the other crowdfunding platforms?
Sure. So I touched on a couple of the things, but to kind of bundle it up, Bright is probably one of the leading in space and aerospace technology, as well as real estate and other energy-driven companies. We are based out of Orlando, and Central Florida is notorious for space companies, technology companies in kind of peripheral to them, and then real estate in Florida. It's just what's kind of where we've grown, and that's where most of the investment in private markets is already. So that's where we've started and are kind of making our niche, if you will. But we do expect it to broaden from there. But what we do is we have a very highly vetted process to go through and evaluate these businesses, making sure they're legitimate, that they have, a decent offering to bring to small investors to kind of take away some of the burden of evaluating them. Not that you should not still evaluate them, you definitely should as an investor. But we're giving them, basically a platform to be able to offer more complex investment opportunities to the general public, especially if you have a background in investing and you have a good sense of what you're looking for. Bright's going to be able to give you the data, the tools, and the opportunities, the businesses that you'd want to see. So that's how we're making a difference, especially in these early days of the higher limit mark, where we have a lot of high expensive real estate acquisitions that are looking to be started, or I guess upgrades. And then the on the other side is the technology. A lot of these are existing technology companies. They already have traction. They're just looking to expand, either develop a new vertical or broaden their their reach. As a lot of the companies, and even our team is internationally driven, so pulling in minds from all over the world, business from all over the world.
Yeah, absolutely. That's great. And I may even add that the platform itself is very intuitive. I spent some time on the platform along with some of my investment partners looking through deals. So great. Um,
Thank you.
what is so my next question is, what is the difference between product crowdfunding and equity crowdfunding for an audience that may not know?
Yes. So a painfully relevant example, and partly why this industry exists, is the Oculus. Uh, it was originally funded through a product crowdfunding on, I believe, Kickstarter, if I'm not mistaken. And people were pledging and donating basically to this success, and once it took off, they were expecting some sort of return on their investment, quote unquote. But it's not an investment. If you're going through a Kickstarter, Indiegogo, GoFundMe, these aren't investment crowdfunding platforms. They're product crowdfunding. You're able to pledge, and you might get a uh, as a backer basically a token of some kind as a incentive to be able to you know donate or offer funds in advance of the company's either product creation or success. And so that's where the original crowdfunding and product funding came from. Crowd investing is kind of a subcategory under crowdfunding, but the difference is you're able to invest through either equity or debt or some combination of the two. And so you actually, if Oculus had raised from a crowd investment platform around the same time, they would be offering some portion of their business, and those investors would actually be entitled to a return on their investment and to be able to gain the massive success that that company now is. And I know we'll probably touch on it in a second, but it might be a relevant example for, in the case of mergers and acquisitions, they were later acquired by like Facebook. So that's the point where once they're bought, that equity is purchased by Facebook, and that's when the shareholders might, exercise their shares and be able to actually make that massive return at whatever Facebook was purchasing them at.
Absolutely. And that leads me to my next question. For first-time companies looking to raise capital, how should they gauge how much to set their crowdfunding campaign?
Mhm. That's a good question, and probably one that we get asked a lot. Um, and it's not an easy, like, straightforward answer. I would I'd say the kind of the established expectation is you don't need to raise more than you need. So if you are looking to acquire a specific, very valuable asset for your business, let's say you're in manufacturing, you have a technology that you've prototyped in a lab, and you need to go to market by creating a manufacturable, replicatable product that's repeatable and not just a once in a time in a lab. That would be something to raise funds for, that might not be grant worthy, that they might have been using before to get their idea off the ground. So they could reach out to investors and say, hey, we're looking to raise funds specifically for the acquisition or the purchase of manufacturing equipment or a contract that they have with the manufacturer who can produce their product or idea, and make it real to go to market, so that they're not having to promise a bunch of people and not be able to deliver. They would have enough capital to go in and make it happen, and then they could start marketing, advertising, all of the other stuff. They might raise enough just to cover that as well. And so then there's two reasons you'd want to do that. you don't necessarily want to raise more than you need, because you don't need just cash flying around everywhere. That's nice and it's probably safe, but you want to stay lean and you don't want to give up more equity than, if you're a founder, than what you want to keep. If you're going to dilute, you want to dilute in a controlled and staged manner. And so offering a small portion of your company usually entails a lower share price, or we can get into the technicals, but you want to be able to offer just enough that it's enticing to investors, but not so much that you're giving away everything. That's not good either. And so it's a bit of a balancing act between the price that you're offering, the percentage of your business, and the funds you're trying to raise in total. Those all kind of play a factor in how you determine that, and it's kind of a case by case thing, but usually that's the rule of thumb.
And for companies that's primarily in Orlando, you mentioned there are the two main sectors are aerospace and aerospace defense, and more so space or manufacturing companies. What is the trend there as far as the combination of raising debt and just crowdfunding and pledging equity?
Yeah, so I would say there's not been a trend, and that's why we have created Bright. Is there is a little bit of complexity that comes with, I'll say a little bit of complexity. It's actually an expression to be called a rocket science, and so not everyone's a rocket scientist, but if we're able to help these businesses that do need capital to start making innovations in technology that take us literally beyond our world, we thought that would be something that's worthwhile to incentivize and help. And then we also know there's an audience for it. We have two investors who we brought on that actually run the Space Channel out of California, and they're part of that campaign to basically help innovation and technology in this sector. And it's really surprising how broad it reaches. If you ask anyone who was growing up during the space race, they could list off all these different products or technologies they would have never thought could exist, but came out of NASA's development and innovation. Now, if you could, you might lose count of the number of space technology companies that exist. And that's something that's becoming more and more normalized, and the economy that will develop based on just space is astronomical. And so it's something that we see on the horizon, and that's kind of where we got our name, is Bright, towards a brighter future. And that's generally how we're approaching, the crowd investing space, taking these very complex, very innovative, very, helpful products and being able to bring them to an audience that understands and gets behind the potential success in the betterment of the world by these technologies existing, not just real estate, but this more high-end technology side.
Yeah, absolutely, absolutely. And I wanted to shift gears a little bit. As you know, a lot of our viewers are in the mergers and acquisition space. Are they so a few questions in regards to that. We've been getting a lot of questions, and of course, we wanted to ask you about. So, are there any restrictions on how the proceeds of the raise can be used? For example, let's say a company in your space, so aerospace and defense company, they're looking to raise capital to actually acquire. Maybe they have a certain part that they need, and it's actually cheaper to acquire a parts company versus making it in-house. So, are there any restrictions on how the proceeds can be used?
So I talked to some of our team members. I'm not 100% sure, but from my general understanding, if you're raising capital and you offer equity or debt in your business to investors, you're going to have to explain, one, what you're going to use the funds for. So you have to do that. You have to say what it's for. As far as what you do with it, as long as it's legal within the general, ruling, as far as the, you know, financial regulations and business regulations, that's fine. But you do have to disclose that. And what you might run into with a merger or acquisition is if you are going to use the funds for acquiring another business, you're also acquiring that business's equity, and it will likely dilute the price per share of your own business by bringing in a whole bunch of others. And so you can look at this in even just the broader markets. They do that where the other company's share price will probably go up very quickly because they're being acquired at a higher price than where they're at. The business that is raising the funds in this example that's going to acquire the other business, those are typically going to, dilute, and they're therefore going to lower their share price. But it's a private market, so they won't. They'll stay the same. They'll purchase the other one, and the shares will be, distributed proportionally to each, owner's value. The overall company is going to be worth more, but each person's diluted. So that's up to the investor to determine if they want to participate in that. If they see that these acquisitions are going to make the long-term difference and the business will be better for it, that might be a great investment for that investor, and they could determine that. But if they feel that it's too risky, or if they don't want to, they don't have to. Again, it has to be disclosed. So that is for sure.
Got it. That's actually a really good answer. And just a follow-up question to that. In terms of so as you know, in the capital capital table of a company, that if a company is raising funds via loan, of course that would be a part of the liabilities. If the company is raising funds by selling equity, so of course it'll affect a different part of the financial statement. My question is, when that company later down the road uh, is up for sale, or even merging with another company, how is that treated in regards to um, having a history of uh, you know going through crowdfunding? Is that more favorable or less favorable towards investors?
Okay, so let me clarify. You're saying if you had to choose between equity or debt as a crowd investor, not the business, which would you prefer in the situation where the business is acquired? I'm a little confused.
Yes. So yeah, exactly that.
Okay. So, I mean, in any instance, debt's going to get paid first. If the company is, defaulting and they go bankrupt, if you own debt in that business, you get paid first. Then the private stock owners, or preferred stock, sorry, and then common stock. Those are all disclosed in the agreement. And so what's not uncommon is for investors, or sorry, issuers of these offerings on the platforms might offer a convertible note where it's initially debt, and then on another round of fundraising, that price will be matched to whatever the next price is, and it'll be offered to the original owner of that note. If they don't go and raise more funds, if they flounder and don't succeed, it's still a note. It's still debt, and so they'll be paid with whatever's left to kind of recoup that. This was standardized, I believe, out of Silicon Valley, and so that's still being refined as far as a contract goes. They're called smart contracts, convertible notes, similar names. That's typically what's preferred, especially in early seed stage companies that maybe are kind of 50-50, where are they going? If they already have some traction and they're looking to just offer a small portion of equity rather than taking on more debt, because let's say right now there's a large amount of uncertainty in the economy, and so they might you might be willing to give up some of their equity for it, and that would be less risky, as you put it, than like taking on additional debt. So I mean, all these things come into play when there's an issue being offered, and that's kind of what's exciting about it is you actually get to be at the table, and there is discussion on our platform and in other platforms and in even forums beyond that, about how to evaluate these things. And it's a dynamic process. There's a lot that goes into it. A lot of it's traditional investing, financial calculations, but these are startups. There's a lot of risk reward balance and diversification, matched with the opportunity. And a lot of it also comes down to just what people believe in. If they see something that is going to make a difference, it's worth taking the investment as equity, debt, whatever it is. It's just better than maybe donating in their eyes. So it's not a great answer for you. There's a lot of ways to let the cookie crumble, but like it's a fun and dynamic process, and takes a lot of evaluation and consideration to do it.
Yeah, absolutely. We think this space is very exciting. There's a lot of opportunities in this space. With that being said, can you provide us an overview of just general benefits or drawbacks with both um, raising with both crowdfunding to raise debt and crowdfunding to sell off some equity? What are some of the risks involved? Um, kind of both on the issuer side as well as an investor.
Sure, I think there's a ton of upsides, but I'm biased, so I'll try my best to give both sides of it. Starting with some of the challenges, right? The difficulty of going through a crowd investment platform as opposed to traditional bank or angel investors or venture capital. Um, you have a lot of options. This is just another one of them to be able to finance your company, especially I would say towards earlier stages. This is not like an IPO. You're not raising hundreds of millions. It's a cap at 5 for regulation crowdfunding, and for Reg A plus, that's up to I think 75 now. And these are accessible to a large number of people, similar to the public exchanges, public markets. And so you have that ability to reach a ton of people. And it's also a challenge to reach a ton of people because it costs money to market, to bring a name if no one's ever heard of you, right? That's where you have the alternatives. You could go to a bank, but they also haven't heard of you. And if you don't have a ton of capital, you're probably not going to get like the most wondrous offer as far as an interest rate, and then you still have to pay that back, and it's taking on a liability on your financial statements. And then you could go to, let's say, an angel investor or venture capital, but you also have to hope that they understand what you're offering, and being willing to give you a substantial amount of money just on your project alone. So it's a larger commitment from the investors at that point. So they're going to be a lot more rigorous than maybe a typical investor might be, because they have more that they're putting at stake. And so that's kind of the I guess, kind of switching over now to the benefits. With crowd investing, you're able to reach a broad audience. You're able to reach your customers basically and communicate with them your long-term mission, your goals, and how you plan to get there. And it's usually, in the best case scenario, coming from a community that's already behind an idea or your business, and you're just now giving them the opportunity to participate in your business by offering them equity, or potentially debt. And then with that too, if you've got this broad audience, they're captive, they're in for the long haul. We get a lot of businesses coming to us to want to raise funds because we're not a crowd funding portal that's like Kickstarter, Indiegogo, where their customers are their customers. They're not there to wait a year for you to come up with their product. They want it yesterday, because it's now just seen as a pre-order, rather than a crowd-funded, company. These are investors who are locked in for a minimum of 1 year before being able to, exchange their equity. Um, and so they get it. They're there because they see it as a long-term investment and not something where they're going to be, constantly messaging you through your portal, or, talking about you as if they're writing reviews on your product before it's ever gone to market. That we've heard from other, issuers who came from other platforms that are not crowd investment portals. So you have a lot of more of this discourse, a lot more of this audience, and you're able to raise now a substantial amount of funds without taking on debt. You can take on debt if you want to do like a convertible note, which is very common. It's not typical, though, that you would just go the debt route. These are people who want to participate in the business in the long haul and are willing to evaluate it and commit, a small portion of what they might own, but, combined together make a substantial amount.
It's a great answer. Great answer. And that leads me to uh, um, my question. So my question is in regards to the different space that we're both in, but I think it ties up really well. So we typically, and I say we meaning just either private equity or business buyers as a whole. Um, we typically invest in companies that do have attraction uh, and typically are profitable, with a couple years of operating history. So for an investor in my space that wants to take advantage of these great new companies, do you typically see companies that are already profitable? I know you mentioned aerospace and defense. Most of the time they are, and they're looking to either raise money for a new project or, basically a new project for the most part. On your platform, what can we uh, expect to see in terms of a mixture of brand new startups or companies that are already profitable and they're raising capital?
So there will be a mix of it. If they have not had a year of financials to show, we will not, just putting it out there, we are probably not going to accept them. And even if it's just expenses that they've put into it, that might be better than nothing. They have to have been around for at least some substantial amount of time developing, prototyping, creating something of value. Um, if it doesn't appear to be, like in traction yet, like we might suggest, hey, try to make your first sale, even if it's just one, to be able to kind of validate your, designs. But some of these technologies are just, they're so complex and so valuable at a broad scale, but not something that you could easily just turn around and deliver. That they have, maybe millions of dollars already invested and already, created for a product that will only be valuable, at like 100 million. And it's crazy, but that's kind of what the deep tech opportunities have, is these like literally life-changing technologies. So think of similar to like you know, the semiconductor, with that invention, we have computers and the world in our hand. That's the kind of difference in some of these technologies that maybe aren't profitable because they're not direct to consumer immediately. So it's not always thinking of it as what is it that we see as profitability. If you're in the mergers and acquisition space, there are definitely opportunities that will be a faster return. That's why we do have that real estate portion, because there are a lot of companies or entities that we have been talking with that have traction, they have revenue, they've probably been running and operating in some cases for 10 to 15 years, and they're just now considering expansion into new markets, and they're looking to offer a portion of their business to be able to help them do that. And it's not uncommon that they offer specific seats for a higher investment to help them do that. So, for instance, trying to open up a new market in a different state, and if they had an investor that was from that state that was willing to offer a substantial portion of the crowd-funded equity, they might give them more voting rights and actually like a seat to help them determine the best way to do it. So that's some of the interesting stuff and some of the flexibility that comes with these longer standing businesses. But yeah, as far you would see it more towards the peripheral, not directly in aerospace and as you put defense, but more like the technologies that might supply and support those businesses.
Absolutely. And speaking of flexibility, I know in the VC space, there's terms and agreements that protects the investor's position in terms of like anti-dilution and things like that. So with investors investing in companies on your platform, how are they protected in terms of uh, that investment not being able to dilute over time? Is there certain protections that investors can take?
So they will be able to choose which types of offerings. I can't guarantee that the companies they pick are going to succeed. I mean, that's beyond my choice. And dilution is actually very common in uh, startups because as you bring on more investment in later rounds, yes, you dilute, but your evaluation, if you've been doing things right, should exponentially increase. So even if you own a smaller portion of the business, it's worth much more. Um, so thinking of owning 1% of uh, a mom and pop shop, it's not a big deal. 1% of Facebook, that's a big deal. Like it's a substantially different deal. So when you're taking that into consideration, you're looking at, what is it that this business has done so far? What is the price that they're offering for some X percentage? And does that sit well with the investor? And are they okay with it because they see this business taking off in a long time? Like if it's a high growth technology startup, that might be worth the risk of taking, only a couple percent of the business because that couple percent, even if diluted, will be worth so much more, in 10 years or so when they've exited. Or if the company's been around a while, they might expect a larger share because they know it's not gonna grow, it's not gonna change, and they're just looking for returns consistently every year through a dividend or whatever else that business might offer. And there's a lot of flexibility in it, but it does come from the issuer, and this is why we get this question a lot: is how do I evaluate my business? How do I present that and offer it to investors? And it's kind of up to them to make the call and make sure that it's the best they can offer because everyone's going to talk about it. It's going to be public and they can communicate and say why they justified the price at the point they offered and for the percent of the business. But once they've said it, they've kind of said it. They have to offer it the same to every other investor that's there. You can't pick and choose who you want. Anyone is allowed to offer, anyone's allowed to invest.
Great. Yeah, and absolutely. I think that's part of the reason why this space is so attractive. It's anyone can invest. Anyone can invest, and the cap is as we know it's at 5 million. So the room to grow is definitely there, and we're just really excited to see what the space has to offer in the long term. And just as a a closing question here, what are your outlook and view of this space? And can you provide us what you expect, given that we're in a um, interesting time, to say the least. What do you expect um, the space to perform in the short run, and then what is your expectation on the long run?
Yeah, both are very bright. the The short run is uncertain. It's destabilized. It's fractured in many different segments, and that is usually, at least historically, when opportunities present themselves to the ready and the opportunistic businesses that maybe have a technology, they have a market that they were thinking of going into, and they maybe have started toward it. This is the moment that, that preparation and timing equals success. So we're seeing a lot of businesses that are taking off now, and if you look at new businesses created, they're growing. A lot of people who are out of jobs, maybe highly skilled people out of jobs, now might be starting their own businesses, developing these new technologies, getting into businesses that will be the ones that are listing 1 year, 2 years from now. And so I see a lot of potential, and this $5 million mark could not have come at a better time, because it's going to be a potential offer, from maybe existing businesses that are fine. They're probably okay, but like I mentioned earlier, having extra cash in the bank might be something they're thinking about. It might open their doors to this new type of funding, because they're going to get more people on it. They're going to have more uh, basically spread an audience, and then they're also going to have that capital to help maybe weather the storm and maybe even take advantage of it. And yeah, you probably have seen this in your space with acquisitions. um, I know a lot of, at least when I was not long ago doing sales and working with last year, businesses that were they had been around forever, and got hit a little hard, a little harder, and they were already thinking of retiring. That business has now been sold off to a larger entity, and been absorbed. So I think a lot of this is going to be moving about. It's not going to be people sitting in their lane doing their thing. It's a lot of uncertainty, which is going to breed a lot of creativity, a lot of new ideas. So I'm optimistic. I mean, it's definitely a hard time in life for everyone, and especially our nation. But I think we're headed to a brighter future for sure.
Awesome. Well, Jake, it was definitely a pleasure having you on the show. Thank you for the wealth of information you provided, and with our audience, given that they may have additional questions, where can they best reach you?
Yeah, I mean, they should definitely check out bright.us, our website, to take a look at the platform. For discourse, we are on Twitter, press.bright, and then LinkedIn. I mean, we're on there all the time, just posting and chatting. You're welcome to check out Bright Investments. We're out of Orlando. You can see us there. Can't miss us. There's a bunch of bright companies out there, but we're probably the brightest, in my opinion. So we'd be happy to engage and answer any questions they might have after.
Absolutely. Well, again, thank you, Jake. And I'm sure our audience got a lot of information from this episode. And I really appreciate the conversation as well. Take care.
Yeah, thank you, Bentley. Really do appreciate being here. Thanks. You too.
Thank you for listening to the Dealmakers Podcast. We hope you enjoyed diving deeper into our guest story and insights on deal making with our host, Bentley John. Right now, there is a tremendous opportunity in the mergers and acquisition space for small and medium-sized enterprises, as it is estimated that in the next 20 years, over $10 trillion will be transferred or lost. To learn more on how to capitalize on this opportunity, visit dealmakersinstitute.com or maspecialist.com.